Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, we'll bring you the latest on Warner Brothers Discovery as Paramount goes head-to-head with Netflix with some big partners to help. Plus, Lululemon and Nike gear up to report their results. We'll preview what you need to know. And we'll hone in on the state of consumer spending as many grapple with an affordability crisis in the so-called K-shaped economy. Let's take a look at the major averages here. So the two-day Fed meeting has begun. Of course, we won't get the Fed decision and press conference until tomorrow. So a little bit of a waiting game in the markets until we get the confirmation of what's going to happen with the Fed. Right now, the Dow is up about 140 points, just about a third of 1%. The S&P 500 up about half that. The Nasdaq trading a little bit lower, down about a tenth of 1%. And we continue, of course, to watch what's going on in the bond market here. Here's the 10-year at 4.15% and down a couple basis points today. But let's look over the past month or so to see what we have seen here. And really, interestingly, rates have been kind of all over the place, even given this very broad expectation now that the Fed is going to cut rates tomorrow or announce a cut to rates tomorrow. We've seen a lot of volatility. And speaking of which, this is the B of A Move Index. What is the Move Index, you ask? Well, this is basically to bonds what the VIX is to stocks and measures volatility within the bond market. So we've seen that come down to some extent over the past month and really this year as well, which has been interesting to see. Of course, prices have mostly gone up as yields have mostly come down. On the macro front, we're just getting U.S. October job openings coming in at 7.67 million. That is higher. The job openings are higher than had been estimated at 7.117 million. October job openings show a 2-month rise of 443,000. So interesting to see that, but not necessarily seeing a reaction here in the markets as of yet. Take a look at what's going on sector-wise for the S&P 500. Communication services and tech down today. That reflects or is reflected as well in the weakness we see in the Nasdaq. Energy and utilities financials are also leading the gains as we watch them today. Of course, we continue to watch NVIDIA on that now agreement that it has with the U.S. government to be able to sell H200 chips into China in exchange for a 25% sort of kickback, if you will, or payment to the U.S. government. NVIDIA shares are trading a little bit lower today, and it's kind of a mixed picture when you look elsewhere within large cap tech. We continue, of course, to also watch the big potential deal or deals in the media industry. Paramount Skydance, remember, launched a $108 billion hostile takeover bid for Warner Brothers Discovery. But to fund that deal, CEO David Ellison had to bring in together an array of banks, billionaires, and sovereign wealth funds. In a letter to the Warner Brothers board, Ellison said the financing partners his firm had lined up to had agreed to forego governance rights. He said that should help assure of its ability to clinch the deal. Joining us now to discuss the likelihood of this deal and even the Netflix bid is Cathy Hwang, a professor at the University of Virginia School of Law who looks at deal making. Cathy, thanks so much for being here.
Thanks so much.
I want to start, first of all, with the sort of regulatory back and forth of this. And it's an especially perhaps thorny thing to discuss because we're talking about the Trump administration, which brings, shall we say, a different regulatory lens than sort of traditional administrations do. So how then do we handicap the chances of each party getting regulatory approval?
Right. So that's a great question. So for both parties, there's going to be an antitrust issue potentially. With deals of this size, especially if they're generally in the same industry, we're going to see now a pretty lengthy regulatory review process. And that's going to be true whoever wins this bid. There's also, of course, the national security review process. And that's where an interagency committee, which is part of the executive branch, reviews that deal for national security concerns. I think the backing from sovereign wealth funds is definitely going to raise some interest there. But the lack of governance, I think, would tip on the other side. And I think a real challenge with the national security review process is that it's very opaque in the best of times, just because, as you might expect, national security concerns are opaque often. But especially in this current administration, I think there could just be some, there's kind of a question mark there.
And when we look at the history of deals that receive funding from foreign entities, particularly foreign entities in the Mideast, what has been sort of the history of those deals, how they've gone, whether they've gotten approval, and how different administrations have approached them?
So I think what's what's very challenging is that it's very hard to find specific statistics on what happens there. The National Security Review process often starts with some less formal consultations between the parties. So the parties have an idea that, if this is going to be a very contested deal, they might not go ahead and do it. And so it's really hard for us to understand how it's not, a straightforward process where every deal goes ahead and does it and then applies, and then we find out why it is that they're approved or not approved, or that they go through or not. So it's genuinely a real big question mark there.
The other thing I want to ask you about, Cathy, I was talking with a guest earlier who worked on a bond trading floor in the 80s when we were seeing sort of the height of, and the beginning, and then the crest and breaking of the LBO wave, the leveraged buyout wave. And I was noting we don't really call them LBOs even anymore, even though they are LBOs. And so I wonder, when you look at these types of deals where a lot of debt is taken on and then it ends up on the balance sheet of that combined entity, how does that tend to go, and what do investors need to be aware of and watching as they look at that kind of a structured deal?
So a leveraged buyout generally, refers to deals that have a lot of debt, right? A classic one that we're thinking about from the 80s would be someone comes in and offers to buy the company, and kind of the company's assets are used to secure that debt, essentially. So I think when we look at that kind of deal, obviously when you look at Paramount's information to the shareholders, they say, well, the other deal has debt involved, and ours is an all cash deal. I think these are all considerations for the board. The type of consideration will affect things like whether the deal is more likely to close just because there is or is not financing. It will also affect, what kind of value the shareholders feel like they get. Another thing that's important here is that the deals are actually the companies are actually offering to buy slightly different things. So Netflix is offering to buy a smaller subset of the company, whereas Paramount is actually offering to buy the whole company. So there are some differences there, both in terms of the financing and in terms of other aspects as well.
And especially since we're not talking about like for like offers, what is the fiduciary duty of the board, and the CEO as they're weighing these deals? Which do you think is more likely then to win on that basis?
That's a very interesting question. So there's a part of corporate law that says that if a company is definitely going to sell itself, and there's tons of nuances there, and that's why I get to have a job, that the company, if the company is going to sell itself, that its job is to become an auctioneer, and the board's job is to become an auctioneer and sell it for the highest number. But of course, when you're looking at deals, there are differences, especially here, because they're actually buying slightly different parts of the company. So it can be hard to value what that is exactly. It's not as though these are two all cash offers, both offering to buy the whole company, and there's simply a numerical difference. They are buying different parts of the company with different financing. And of course, the regulatory part is important as well.
And what, Paramount's deal or offer being hostile, right? Sort of trying to take it straight to shareholders. Again, when you look at the sort of history of those types of approaches versus an agreed upon deal, is there a likelihood that one or the other is going to be successful? Does it tend to go a certain way, or is it really case specific?
Quite case specific, it depends. I think that one thing is, when you are looking for a tender offer, when you launch a tender offer, you're trying to get a lot of the shareholders to tender their shares, to sell their shares directly to the buyer. Here, we're just going to see if enough shareholders tender their shares. It will also be really interesting to see what the board's recommendation is, the Warner Brothers Discovery Board, what their recommendation is, which they'll make within a few days to their shareholders about whether they should take or not take the offer. Another, I think, interesting aspect of this is that Paramount was actually involved in they made several friendly offers as well, and modified it a few times, and then ultimately got rebuffed. And so it's really interesting to see, this friendly deal flipping to hostile deals, which definitely happens.
Yes, indeed it does. We'll see how it turns out. Cathy, thanks for your perspective.
Thank you so much.
Coming up, we'll get a different perspective on this deal and talk about maybe who the real competitor is for some of these streamers, the one that we're not talking about. We'll be right back. Netflix quickly faced opposition after announcing its $72 billion bid for Warner Brothers, but a hostile bid from Paramount Skydance threw a new wrench in the streaming giant's planned deal. Joining us now to discuss it all is John Klein, CEO of Hwang Media, which is a Gen Z fan engagement platform. And of course, John also served as the president of CNN US. Thanks so much for being here.
You bet. Thanks for having me.
Look at you with all your awards behind you, John. That's how we know we're talking to the right guy.
It's all the work of others, but I happen to be in the right place at the right time.
I love it. So it's good to have your perspective on this. And what I'm curious to ask you is, who are the winners and losers in this whole situation? Because there has been a lot of talk out of Hollywood. They're not super happy about the Netflix bid. So I'm curious from your perspective how you're thinking about the winners and losers question.
Well, YouTube is a big winner because the biggest competition that Netflix and everyone else in the media industry faces is from YouTube, which has about twice the viewing time spent than Netflix does in any given month. And this deal, whoever ends up with this prize, so to speak, it is not in any stronger position vis-a-vis YouTube, whose popularity is powered by content creators, not classic studio-produced traditional content. And this whole deal begs that question. And you could argue that for a lot less money, Netflix could be addressing the YouTube challenge instead of making this deal.
So you're suggesting that Netflix could kind of have its a homegrown version of YouTube, for example?
Homegrown, they could acquire one of the content studios, the creator content studios that are now springing up, Darman Studios. There are others who are pushing out a ton of hugely popular content and developing the kind of insights into marketing to that Gen Z audience that's devouring all that YouTube creator content. And by the way, AI is going to feed the content creation economy even more. So it's already an explosion. It's going to become nuclear pretty soon. And so buying Game of Thrones, buying Friends, which is what this deal, is driven by in large part, in order to increase your share of the streaming market versus Amazon Prime or Disney Plus, that's not taking on YouTube in any meaningful way.
Right.
And in the meantime, also, think about where advertiser dollars are going to go. Now, advertising is not a huge needle driver for Netflix yet. They have launched a new ad-supported tier, and it represents about 6% of their current earnings. But if you're a CMO trying to figure out where to put your ad dollars in next year, in 26 and in 27, all of this confusion surrounding what becomes of Netflix, what becomes of Paramount Plus, where HBO Max, you might just start pushing even more money than you already are to YouTube, Amazon, Meta. In other words, the guys who are sitting this fight out could just sit there and welcome increased advertising dollars coming their way as well.
Really interesting. I mean, me as a Gen Zer, I'm happy to pay for that human-produced content, for now at least, but I mean, they didn't need to buy more of it. I guess I'm pretty happy with the stuff that exists anyway, John. But, and in your view, okay, so putting that aside for a moment, it sounds like you really think that the tech companies and YouTube are going to win no matter what, while all of us are watching the sideshow over here. That said, as I referenced, there is this sort of opposition in Hollywood to Netflix, and it feels like it's the entity that a lot of people want to criticize but don't feel like they have the power to. Do you think that Netflix buying Warner Brothers makes issues in Hollywood worse, or what do you think that effect would be?
Well, those issues are kind of inevitable. I mean, there are just so many secular headwinds that are crushing the traditional media business. And by traditional, I mean studio-produced content, regardless of how it's delivered to you. So in that context, I'm thinking of Netflix as more traditional media company, ironically. And they are too. They're thinking of themselves that way in making this enormous offer for WBD, right? They're putting an enormous value on what that content will do to further increase their market share in streaming. But it's pretty obvious, I think, to see that this is the high watermark of that value of that traditional content. And so, they may well look back a few years from now and feel that they way overpaid. That's how AT&T felt when they paid even more for the same batch of content back in 2018 when they bought Warner Media at the time. And they quickly disgorged it. Within a couple of years, they sold it or spun it off, or reverse Morris trusted it to Discovery, and they just didn't want to deal with it anymore. And you could look at that scenario a couple of years from now. Meantime, YouTube will continue to grow. Amazon Prime will continue to grow. And Amazon's advantage in this scenario is not only do they have the programming, but you can click to shop the video right away. And so you get that sort of retail advertising dollar as well as the streaming digital dollars. So all those folks who are sitting this one out are in a better position, I think. Now, I understand the Paramount bid. They are going to fight for this to the end, because acquiring WBD does vault, or would vault, Paramount into the top tier of streamers when they combine HBO Max with Paramount Plus and all that content, Game of Thrones, Friends, etc. That makes Paramount much more of a player than they currently are. So I understand they're thinking about it, and they're new to the party.
Right.
And so, they're attacking this with vigor. And and they've got financial backers, and so they're not going to let go of this, and this is going to play out for the next year and a half easily.
John, I'm curious, since you brought up, of course, the AT&T Warner Brothers bid. We all remember AOL, Time Warner. There've been a lot of media deals that have not worked out very well. On the flip side, there have been ones that have worked out really well. And when I think of the history of media deals, you don't think of a lot of standout good examples. So I'm curious from your perspective what they might be.
I think the deals have worked out well for the sellers, not so much for the buyers. Ask David Zaslav. I mean, he was a buyer a couple of years ago. He bought those assets from AT&T, or however they financially engineered it, and he's now selling them again. And I think Rupert Murdoch is probably happy that he sold the Fox assets to Disney at the time. Disney's overall value since acquiring those Fox Entertainment assets has fallen. So the sellers are making out okay. And I think out of all of this, Jeff Bewkes, we've got to look. He was the CEO of Warner Media when they sold that to AT&T, and he got $100 a share or more. Brilliant. I mean, that's just the back of his baseball card is very impressive. And also, I have to say, Moelis and Company, and I've known Ken Moelis for most of my life, and he can convince people of their self-interest like few people I know. And they were advising Netflix on this acquisition, and they did a phenomenal job because everyone thought that Paramount had the pole position. So hats off to Ken and his team just for being able to steer it to this point.
Right.
We're not done yet. But, episode 1, season 1 of this Game of Thrones is just beginning. It's going to be interesting to watch.
And it sounds like there's a lesson in here for anyone brave enough to hold media stocks, that these tend to be better for the sellers than the buyers. I think that's something that people would do well to remember. John, thank you so much for being here. Appreciate it.
You bet.
Private equity is an $8 trillion industry that originally began by investing in private companies to achieve higher returns than public investments. But in recent years, it has expanded to private credit and beyond. Oh, and many private equity firms themselves have gone public. So let's discuss the key players and the outlook for the industry. Joining me now for more is Brian Sozzi, Yahoo Finance executive editor.
Yeah.
Let's talk about this. Well, we should say, why are we...
So we're going to have exclusive coverage all day tomorrow inside Apollo, which of course is the parent company of Yahoo Finance. Some amazing interviews, capped off with a chat with Mark Rowan, the co-founder and CEO of Apollo. But for me, I'm really interested in a couple areas of this company. One, Athene. We all like to focus on Apollo as a private equity powerhouse. They have built up a giant retirement business. And they have a significant market share of the retirement and annuity industry. Curious on what the outlook for that business is if we do get another rate cut tomorrow and maybe one more. What does that mean for the annuity industry? It doesn't mean anything because we are getting millions and millions of people retiring literally by the day. So there's that. Also interested in exits, and I got a good stat from EY. Private equity firms have announced exits totaling $470 billion so far this year. That's up 40% year over year. So
what's the return on those exits, though? That's my question.
They don't put that out. But like your conversation was just saying, it's often good for what the sellers. But just the fact that those exits are picking up after a while is a good thing to see for the private equity industry. And then also, too, deal volume has been pretty good. Third quarter deal value in the private equity industry hit a record $310 billion. So there are some pockets of strength. It's just a matter of, do these pockets of strength get stronger next year?
Well, I'm really curious about the industry overall, the private equity industry, because it has been pushing so much into the so-called wealth channel. That is wealthy individuals in the U.S. who want access to these types of investments. But of course, we should remind folks who are watching, private equity comes at a cost, right? There are high fees that are associated with many of these investments. And so the question for regular investors who are being exposed to this universe for the first time is what it's going to cost them, what their total return is going to be when all is said and done, and what is the return on investment going to be like? Because, as you say, private equity has been extraordinarily active, not just in buying companies, investing in companies, but in expanding into credit, infrastructure, real estate, data centers.
Data centers too. I'm really interested too, of course, President Trump signed that executive order a couple months ago that you could potentially invest in private equity as part of your 401k.
Right.
So that could be
not a done deal.
Not a done deal.
Yeah.
But I'm very curious on what that means for the private equity industry. I mean, that is a potential large pool of capital that these companies could get a piece of to further boost their business. And then private markets too. Mark was out with a good op-ed, I believe, in FT a couple of days ago, making the case, that the problems we saw in the private credit markets with two companies a couple months ago, that wasn't reflective of the broader investment grade private credit industry. So I made a very good point there. I think that industry, $38 trillion, the investment grade private credit, and where we saw some of those rumblings a couple months ago, about
Tricolor and
Tricolor, that's correct, yeah. So smaller part.
Yes, exactly. That seems to be what the defenders are saying, but there's still concerns percolating out there.
Yeah, I'm excited. It's going to be a good day of chat on Fed Day. Yeah, ready to do it.
Should be good.
Yeah.
All right. Thanks a lot, Sas. And tune in tomorrow beginning at 9:30 a.m. Eastern for a full day of interviews with Apollo Global Management, the parent company of Yahoo Finance. Coming up, we're going to take a look at some of today's trending tickers. Stay tuned. You're watching Market Catalyst. Now time for some of today's trending tickers. We are watching Microsoft, Campbell's, and PNC. First up, Microsoft. The tech giant said in a post on X that it is investing $17.5 billion in India over the next 4 years. It's the company's biggest ever Asia investment, and it's aimed at advancing India's cloud and AI business. CEO Satya Nadella said Microsoft was making the investment to help India build, quote, the infrastructure, skills, and sovereign capabilities needed for its AI future. Next, Campbell's. The company reported lower profit and revenue in its latest quarter, citing continued weak demand for snacks, though consumer shopping behaviors and at-home cooking trends do continue to benefit its meals and beverages portfolio. The food and beverage maker also said it has agreed to acquire a 49% interest in La Regina. That's the maker of Rao's pasta sauce. Campbell's has previously said it would more closely partner with its suppliers, including La Regina, in an effort to mitigate added tariff costs. And PNC, the Pittsburgh-based lender, said its high-net-worth customers can now trade Bitcoin directly through their investment accounts. That fulfills an initial goal of its partnership with Coinbase Global announced in July. It's the latest example of a traditional financial services provider offering digital asset trading through its own platform. Also part of the deal, PNC provides Coinbase with banking services such as treasury management. Well, millions of Americans are feeling the pinch of rising prices, with the cost of groceries causing significant strain. According to a recent survey by Axios and the Harris poll, nearly half of Americans say it is harder to afford groceries today than it was a year ago. Joining me now is Ricky Volpe, former USDA economist and Cal Poly professor of agribusiness. Ricky, thank you so much for joining us. I think anecdotally, a lot of people are feeling like they are seeing those grocery prices go up. But of course, if you look at CPI and things, it bears out there as well. And, as someone who watches agriculture, there are lots of different reasons why different prices go up. But is there sort of an overarching reason that you can point the finger at for prices in general going higher?
There's no question that we're starting to see an impact of the current administration's tariffs on food prices. It's not overly striking. Food prices aren't running out of control, but the food at home CPI, which is, it's a data service from the Bureau of Labor Stats. That is what I think that's the benchmark for looking at what's going on average, is reflecting, food prices are absolutely going up. Food prices are up about 2% of the year, and it's normal, but there's, a little bit of time left in the year. But they're increasing upon already very high levels. And if we look at where some of the biggest increases are, it seems increasingly plausible that we're seeing impacts due to higher packaging costs, higher transportation costs, higher storage costs. And those are at least in part, a function of some of the tariffs that are in place on steel, aluminum, paper, other key inputs to the food supply chain. I think as we get into and get through the final quarter of 2025, we're really starting to see that take effect in some categories specifically.
So, Ricky, there's sort of the tariff-related stuff and the non-tariff-related stuff. On the tariff-related stuff category, as you just mentioned, steel and aluminum packaging costs. So it seems like you're suggesting that we're definitely not done with price increases. Do you think we could even see an acceleration in packaged good increases because of those costs?
That is my concern. I don't have a crystal ball, and you talk to an economist for a forecast, and good luck. But I will say, I will say there are a lot of moving pieces, but as I look at what's been going on through 2025 and what's going on right now, I am concerned that food price inflation is going to accelerate through the end of this year into 2026. We've talked about the tariffs. Most animal product prices are still very high. That has little to do with tariffs. That has to do with low inventories, high feed costs, issues like that. We're seeing energy prices rise. We haven't heard a lot about that recently, but if you look at the last few months in the CPI numbers, electricity prices are up 5% on the year. Crude oil prices are starting to pick up again. And then, it's a reminder that these tariffs we're talking about, they're not happening in a vacuum. And so I'm concerned that as we start to see some of these fundamentals that drive systemic food price inflation, throughout the supermarket, as they're starting to tick up, these tariffs, which are increasing, like I was saying, packaging, processing, manufacturing costs, basically increasing the bottom line for food companies that are operating on thin profit margins. Yeah, I'm concerned that the pieces are starting to align for 2026 to be a year of above average food price inflation.
And Ricky, you mentioned that there are some other factors affecting, in the non-tariff category. Let's just take beef as sort of a case study there, right? So you have these sort of prices that are being affected by tariffs going up in other areas. And then you have something like beef, which has to do more with what? The sort of cycle of how people raise cattle. Is that how it works?
Well, yes. So the cattle inventory in the United States over time does follow a somewhat predictable cycle, but the cycle is not responding very well to demand factors. What we have found effectively since the Great Recession, since 2007, 2008, we found that beef demand in the U.S. is very stable. The demand elasticity is very, very low for that. But for a number of reasons, we have not seen any significant investments into the expansion of the cattle inventory in the U.S. So we can get into that. I mean, it's kind of a long story, but raising cattle in the U.S. is a risky and expensive proposition, even as retail beef prices remain elevated. And there are some structural issues with consolidation in beef packing, but it still is the case that here we are in 2025, and the cattle inventory, the marketable cattle inventory in the U.S. is about the same size as it was in 1955.
Wow.
So we have a severe disconnect between supply and demand, and that's keeping beef prices very, very high.
So whether we're talking about beef prices or any of this other stuff, when we talk about other types of commodities, and I take gasoline as a prime example, the old saw is the best cure for high prices is high prices, right? That you do have that demand elasticity, people drive less. What about on the food side? Do we see any of that? Do we see people making different choices? And do we see people who are selling the food make adjustments accordingly?
Well, the people selling the food, the sort of narrative that at least I've been hearing for basically since COVID-19 is this trend with shrinkflation, which I'm still not convinced is truly a widespread phenomenon through the supermarket. The idea that package sizes get smaller and the prices go up. I'm not saying it doesn't happen. What I am seeing is, retailers and food companies responding with stronger promotions, more bulk items, more seasonal products, sourcing more locally. That's some of the reactions I've seen more recently. On the consumer side, of course, we know people have to eat. So as food prices go up, we typically see people move away from food service and restaurants to the supermarket. Then within the supermarket, we see people moving away towards name brands and towards these sort of store brands, these private labels. And then when things get harder and harder, there's more of a substitution, more of a movement towards bulk commodities, basic foods, more of a focus on home cooking from scratch, because it's worth reiterating. It is still true that is the cheapest way to feed yourself and your family is to buy the commodities, cook at home, and prepare it from scratch. End of the day, you're going to spend more time, but you're going to spend a lot less money on preparing those meals.
Ricky, really great perspective, very helpful. Perhaps another time we'll have you back and we can really dive into the beef supply chain and get some more insight into why the cattle herd is the same size today as in the 50s. But we'll leave that for another time. Thank you.
Thank you for having me. Thank you.
Coming up, everything you need to know about credit cycles. Jared Blickery breaks it down in today's Stocks in Translation. Stay tuned.
2025 is nearly a wrap, and we just got a couple of nasty credit scares on the tape. JP Morgan CEO Jamie Dimon is calling them cockroaches. If you see one, there are probably more hiding. So investors are asking a very simple question. With the Fed still in cutting mode, are we heading into a safer environment for stocks or into a new round of credit trouble? BofA's Savita Subramanian looks at the data and says we might be due for a credit cycle, not in 2008 or not like 2008, but a phase where borrowers get squeezed and lenders, they get pickier. So the top gun question of the day that we're answering on Stocks in Translation, as we fly into 2026, is the air still clear or are we quietly entering the credit danger zone? Let's start with what a credit cycle even is. It's simply the rise and the fall of available credit in the economy, specifically in bonds and loans that companies use to borrow. When money is easy, everyone gets a loan. And when money tightens, only the strongest borrowers make the cut. If you've ever seen your credit card limit go up in the good times and then get cut back, you have lived a mini credit cycle. Now to the big questions for stocks. This Foursquare shows how stocks have historically responded to different Fed and credit backdrops. When many of us hear that the Fed is cutting rates, they think green light. But BofA reminds us that if the Fed is playing catch up and the economy is actually heading into trouble, the worst box for equity is the bottom right one. That's when the Fed is cutting while the credit is tightening, the real danger zone. And that's when growth is slowing. That's when lenders are pulling back at the same time, even as rates are falling. So earnings get squeezed and investors start hitting the sell button. The open question for 2026 is whether we have drifted into that box. So what makes this potential credit cycle different from the global financial crisis? Well, back in the GFC, the problem sat inside bank loans and housing. Today, the risk has shifted to private lenders and shadow credit. Instead of housing and banks at the center, BofA flags growth, media, and cable borrowers as the new hotspots. And whereas public bond loan markets were the story last time, this time around, private credit markets are seeing higher default rates than traditional high yield. So where are we right now on the stress meter? This blue line right here is our stress barometer. It's the price of a 10-year Treasury ETF, IEF, divided by the junk bond ETF, HYG, and this is going back to 2018. Think of it very roughly as a VIX for corporate credit. When the line spikes, investors are dumping risky corporate bonds and hiding in treasuries, the danger zone. When it drifts lower, credit is generally easier. And that big spike in the middle shows what happened in the early pandemic when credit market froze, right here. But if you look where we are at the far right of the chart, we're actually off of the 2025 lows, but still pretty muted versus history. The biggest spike in 2025 is the post-Liberation Day risk-off moment. But those two cockroaches Jamie Dimon was talking about didn't register much, so it's quite possible they were just one-offs as opposed to warnings of systemic risk. So what belongs on a credit danger zone watch list? First, watch high yield bonds versus treasuries. Let me get that clear. Well, that's not going to cooperate. As treasuries, as we just laid out, are investors still willing to own risky corporate debt, or are they running back into the arms of Uncle Sam? Then keep an eye on regional bank stocks, ticker CARET KRX. These are the lenders to small businesses and also local real estate. If they start rolling over while the Fed is cutting, that is a red flag. And watch headlines for media and cable debt troubles, That's one of Savita's new risk areas, and it's where streaming battles and cord cutting meet higher interest costs. Then, are weaker companies still able to refinance and roll their debt? Cracks show up in smaller, weaker companies first. And then finally, don't forget Main Street credit stress. Watch consumer credit card auto loan delinquencies and households. If they start falling behind in a big way, guess what? Jamie Dimon's cockroaches move from the private credit basement into the living room. Bottom line, we're nowhere near pandemic territory and much less of the global financial crisis. That's in the rearview mirror. But investors will be on alert for that danger zone as 2026 develops. And tune in to Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website.
Coming up, a look ahead at earnings from Lululemon and Nike, plus why consumers may need to prepare for higher apparel prices in the coming year. Lululemon is set to report earnings for the third quarter later this week, with Nike following not too far behind. Both retail names have struggled this year as tariff uncertainty weighed on margins and uncertain consumers have hunted for deals and discounts. I want to bring in Randall Connick, Jefferies retail and apparel analyst. Randy, it's good to see you. I think with both of these companies, one could also argue it's not just the broader environment, it's stuff that they've maybe done themselves, particularly when it comes to your views on Lululemon, where I know you haven't underperformed. So what are you looking for from Lululemon when they report? What are you going to be zeroing in on?
Yeah, look, I think with Lulu, the struggles have been pretty clear. We've been celebrated for a number of years now. And the issue is competition. So this company has made some strategic mistakes in terms of moving away from their core customer, in terms of focus. They've also moved away from their core product areas of expertise in areas like leggings. They've moved to other products like sweaters that are non-core, or put logos on everything. So what we need to hear from the company is a kind of a mea culpa that we've made some big mistakes here on what we've done strategically. We're trying to rectify those mistakes and then give the market confidence that market share losses that have occurred over the last couple of years will start to bottom. I actually think that's not going to be in the cards this year. We think that the brand is not on Santa's list for holiday this year.
Yeah, it doesn't sound like you think so. I mean, why do you think that management has not been more willing to revisit some of these decisions, to maybe course correct? What is preventing them from recognizing what you say is happening there?
Look, I think it starts at the top. I think the company is, leadership's in denial, right? That there's something wrong. They had said for a number of years that, a number of quarters, that the competition's not a problem. It's just that they didn't have enough color. They didn't have enough patterns in the products. They didn't have, quote unquote, enough newness. And now they've tried all those things, and yet the numbers keep getting worse. The sales trends keep getting softer. So I just think it's going to probably take an outside party to kind of shake the trees, if you will. I do think that the CEO is not really probably long for the game going forward, and he's biding his time. While I do believe this is going to mark a very difficult Christmas selling season for the company.
And conversely, Randy, I mean, I know they're private, so you don't cover them, but are we going to see strong numbers for the likes of a Vuori or an Alo Yoga, for example?
Yeah, look, Vuori and Alo are making strides every day. We've done a lot of work around real estate that shows that these two particular brands are putting stores up everywhere in high-performing malls, in high-performing street locations that are literally down the street or down the mall, the hallway from Lululemon locations. So they're feeding off of what Lululemon used to get from a traffic perspective and taking that traffic away. That creates a big problem for Lulu because they have sales per foot that are Apple-like in the mall versus other retailers. And that means that that's a lot of market share up for the taking that can go to Alo and Vuori. So to put it simply, we think that because of the store transfers or the store growth from these other businesses, that they're going to take massive traffic share and wallet share from Lululemon, not just this holiday, but into 2026 and beyond.
So that's Lulu. Let's talk about Nike, which I think you can argue is in a pretty different position here because this is a company that has tried to seemingly recognize where it wasn't going right and is trying to course correct. The question there is, where are they in that trajectory?
Well, the good news on Nike, we upgraded Nike earlier this year, so maybe a bit early, but obviously it's performed massively better than Lululemon, although both their stocks are down for the year. What they did was something very important starting at the end of 2024, which is they got rid of the CEO that didn't work, right? That was an outsider that was elevated to CEO. He was a board member previously, John Donahoe. They brought back former head of wholesale, Elliot Hill, to run the business. And he's done a really remarkable job of fixing the culture at the company. And not only that, providing some simple strategies of fixing the product and balancing distribution that I think are very smart going forward. And the beauty of Nike versus Lulu is Nike's numbers have already collapsed. Operating margins are cut in half, earnings are cut in half from the peak. So what we're dealing with here is a stock that is kind of underperformed a little bit this year, but has the better kind of comparison trend, if you will, going into 2026 with, again, earnings cut in half, operating margins cut in half, and a CEO that we believe in going into next year.
So, Randy, when they report, what do you think that Nike, I mean, I know that some investors have been patient, some have not, judging from what the stock price has done this year. But when they report on the 18th, what do you think they need to say at this point to convince folks that they are on the right track?
Look, the magic word for Nike on the 18th is the word progress. We are making progress with those strategies, whether it be a better product, progress in balancing that distribution, and giving some proof points of fruits of that labor in the form of giving us backlog trends, looking at go-forward sales trends. The point is, you want to see the progress being made. And they've already started to see that progress. As it pertains to the running category, you've noticed in the last couple quarters, Nike's put up better running trends, up, and not only up year over year, but sequentially accelerating. So that tells you that that when they make a choice to impact a certain area of the business, it's working. In this case, the company's focused first on running. We soon expect other product areas to follow suit, with the company working on training, basketball, and then over time improve that lifestyle part of the footwear offering that's been challenged for the business for the last couple years.
Randy, this was fun. Thank you. Appreciate it.
Thank you. Thanks so much.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages here today, a little bit of a waiting game here today, a little bit of water treading, if you will, ahead of the Fed decision tomorrow. The Dow right now up about 130 points, about 0.25%. The S&P and the Nasdaq each up a little more than 0.1%. Well, a debate over the poverty line in America has been going viral. The official U.S. poverty threshold for a family of four in 2024 was $31,200. But a recent set of posts on Substack challenged that number, saying the real poverty line is closer to $140,000 for a family of four. Joining me now, the author of that Substack, Michael Green, Simplify Asset Management Chief Strategist. And Mike, before we dive into it, I just wanted to walk through how you got to that $140,000 number here, because you're looking at various inputs, right, to household expenses. So you use national data to calculate average childcare, housing costs, then you added up food, healthcare, taxes, transportation here. All these are high numbers, and then you add other essentials, and that's how you got to that total of $136,500 specifically. Now, as you well know, there's been a lot of arguments around this number since you came out with this estimate, Mike, but I wonder what your take is on the debate that this has engendered and what you've taken away from kind of all this back and forth.
Well, Julie, first of all, thank you. That's a fantastic graphic, by the way. I think I'm going to steal that for any future versions of this. Yeah, there's been an extraordinary amount of debate around it. I think much of it has been a function of an ungenerous reading where people are effectively trying to assert absolute versus relative levels of poverty. What was the entire point for me was not to actually dig in and define a new poverty line. It was to understand what the average American household was experiencing. I built those numbers up from the MIT living wage components. The real surprises are things like childcare. And as people correctly note, childcare is not something that every family or every household has to do. That's why I was very specifically focusing on the experience of young families in America trying to answer the question, why are we not seeing more household formation? Why are we not seeing more children being born, given that the millennials are now at the point at which they should be at peak fertility levels? The answer is very simple. It is super expensive to have children in the United States today. And childcare one is the one that should be jumping out at people, particularly when you're thinking about components like the New York City elections, et cetera. I think the thing that frightened both sides of the debate, the left is very frightened, understandably, that this distracts the focus from the officially poor, those who are genuinely, suffering true deprivation and true insecurity. And on the right, there's just an incredible fear of opening the idea of more progressive taxation and the idea that there could be institutional needs, for example, around childcare, as Mondami has proposed, government-driven healthcare. On the right, I am terrified and others are terrified that that would end up being the solution that is proposed, right? A new government bureaucracy of childcare, for example. And so on all fronts, we got a tremendous amount of pushback from the institutional or the official sector. Julie, the incredible thing was I received in excess of 10,000 messages and an incredible number of comments on press vehicles where people basically said, oh my gosh, somebody actually understands my life.
Well, and this is what's so interesting about it, because I think there are political implications of this, there are economic implications of this, but we keep talking about, and we've been talking about for the past couple of years, the so-called vibe session. I was talking with one strategist this week about the vibe-pression, the implication being it's gotten worse, and that there is this gap between what the numbers say and how people feel. And depending on who's in office, they kind of tell people, well, you're not really feeling what you're feeling. And so I guess what this did was sort of help to validate what some people are feeling. Like, we're not just making it up, even if we're not poor, quote unquote, even if we're not actively struggling to put food on the table, this is not an easy environment.
Yeah, I think that's right. And I think that's really the critical thing for people to understand is that a sizable fraction of the U.S. population, particularly those we are relying on to create the future workers and future voters and future taxpayers, are saying, guys, this is actually impossibly difficult. And it's not a function of them being weak and incapable of doing it. The simple reality is, in a world in which, in order to afford to rent or buy a home, you need a second income, childcare becomes a very real component of it. Historically, that could have been provided in the neighborhood or by family members. But oftentimes, jobs that allow people to afford these opportunities are far away from those support networks. And so this has become the increasing reality for young families in the United States. and it's simply untenable.
What's also interesting, again, to take the economic side of it is, if you look at the aggregate, if you look at the big numbers, if you look at GDP is fine, and it doesn't necessarily need all consumers to participate. That's what we've seen sort of historically, right? And not only that, but enterprise spending is making up a bigger piece of that pie as well, in part because of AI. So from a purely economics and not a human perspective, how concerned do we need to be about the realities of people being stretched in this way?
Julie, it's a great point. And I often direct people to this, general observation. When we think about a number like GDP, many of us who will be listening into this type of program will have taken introductory economics classes in which we're taught about the production possibilities frontier, the combination of technology and capital and labor that allows us to generate that GDP. And we measure GDP as potential GDP and realized GDP. The simple reality is there is no one production possibilities frontier. It's not like there's a giant, national production possibilities frontier. That is shorthand for aggregating every individual household's production possibilities frontier. And that's where the breakdown is occurring. We're actually seeing more and more households who are incapable of clearing that threshold for participation in the modern economy. That means that they are either moving to much lower cost regimes in which they don't have access to the types of jobs that are developing. It also means that those companies lack the employees in the right place, so they're not able to fully produce. Almost every analysis that I have seen or done myself at this point around the impact of the inequality of the distribution of income, wealth, capital access, job access, et cetera, suggests that our economy is operating far below potential because of these constraints.
So, okay, so that tells us what the sort of potential economic risks and implications could be. What are the remedies, which are more on the political side, as you alluded to? Like, what do you do about all of this?
Well, the simple answer is, and this was what part 3 of the Substack was about, is that we have largely been sold a lie about the distribution of taxes in this country. As a member of the upper income cohort, I will tell you that what we are told all the time is the wealthiest Americans pay 50%, 1% of America pays 50% of the income taxes. That is true in a very technical sense, right? Because I'm isolating to income taxes. But if you look at your paycheck, the largest income tax that you are paying that you don't really distinguish between the two is actually the FICA taxes, which are paying for Social Security and Medicare. Those are the largest components of most people's taxes. And those are limited so that you do not pay taxes on those above $168,000. So if you actually go through the math, as I did in my last piece, what you discover is that the last 50 years has seen an extraordinary tax cut for the wealthiest Americans and an extraordinary tax hike for those in kind of the 20th to 80th percentile. Ignoring that is really at the core of the issue, and refocusing people on honest discussion and debate about the tax burdens and how the U.S. government is financed is really what's necessary at this point.
Is anyone having that conversation?
I'm certainly trying to, and I will tell you the fascinating thing for me was the reaction to my first piece was this outrage about the 140,000, which by and large people have actually come back. I mean, one of my favorites is somebody saying, well, the average cost of childcare is not $32,000, it's $26,000. Okay, fine. Right. So it's not 100%, it's 90% of the government's poverty line. The pieces that start to talk about here's what we have to do, it's actually been very interesting to watch the think tanks disappear. Because at the end of the day, the think tanks understand that they are funded by those who are amongst the wealthiest and highest income Americans. And that's just the conversation they don't want to see the light of day with. And so, that is really the question. Are we going to start talking openly and honestly about real solutions rather than the platitudes that we've thrown so far?
Mike, finally, I'm really curious because, your day job is in an ETF shop where you're the chief strategist, and you do this Substack where frequently you write about markets. You're not necessarily writing about these sort of bigger picture issues. Does this have something to do with your day job? Is this something you're kind of doing on the side? I'm just curious how you sort of came to this.
Well, I'm also chief dishwasher, so let's be clear that I hold multiple titles. No, look, my Substack has always been a process that I've engaged in for really the past 20 years, where I write my thoughts on a weekly basis. It's an area for intellectual exploration. Sometimes that's very analyzing what I saw in the markets or what I think is going to happen. For the past couple of weeks, I really got drawn into this question of what's really actually happening in American society that's causing this disconnect between the perception that the economy is doing really, really well and the articulation that there's an affordability crisis, which some have labeled fake news and others are insisting is really important. It was really me just trying to understand that. And as I dug in, I said, wait a second, this is actually a pretty big deal. And so made the initial post available to the public for no charge, and it went viral.
Would you call it then an affordability crisis as you came to?
I think it is an affordability crisis. I think what most people are missing, myself included up to this point, is that the discussion has largely been around prices or inflation. And when you think about it in that context, inflation, defined as the year-over-year change in the general price level, has largely normalized. It's running about 2.5%. That's well within the range of error of what we have had historically and shouldn't be that big of a deal. But the problem is that the analysis that I've done now suggests that many, many households are actually starting out from a point at which they're underwater. And if you just mechanically think about a household that has that starts from the underwater position, let's say, to use round numbers, their income is 90 and their expenses are 100. They have negative savings of 10, and they look at that and they say, well, I hope to get a raise and prices will come down and things will get better. In the last year, their income has gone up, give or take 2%. Just doing the math, that would take you to 91.8, and their expense level has gone to 102.5 with that 2.5% inflation. So they are further underwater than they were before. That's the affordability crisis. That's what people are upset about. That's why we're hearing a demand for lower prices, which obviously would be wonderful in many, many ways, but also probably represent significant economic slowdown. We don't want the economic slowdown. We need to recognize that these people are trapped underwater and we need to help them.
Mike, really interesting stuff. I'm sure we will continue this discussion, and I'm sure lots of people will continue it with you online. So good luck to you on that front.
Thank you very much.
Thanks a lot for being here.
My pleasure.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. As we've been discussing this morning, U.S. consumers are dealing with higher prices across a wide range of categories, and those price hikes are often the result of tariffs as well as the flow of cargo into U.S. ports. So let's take a deeper dive with someone very familiar with the flow of goods. Joining me at the desk, Gene Soroka, Port of Los Angeles Executive Director. Great to see you.
You too, Julie.
So we have talked before about the effect that tariffs have had on the flow of cargo into U.S. ports. So where are we now? I imagine that most of the stuff that was coming in for the holidays is here already, but what's the cadence that you're seeing and what are the price changes that you're seeing?
It's been a really up and down year. When hard policy came out, people slammed on the brakes on imports, and then knowing the policy may change, we did get some windows throughout the year when trade deadlines were extended and cargo really took off. So we land at the end of the year, probably our third best in volume for the history of the Port of Los Angeles. And December itself looks to be a little bit above the 800,000 container unit mark, which means getting ahead of an early Lunar New Year seems okay.
And is it also, as to your point, those windows of okay, we better get in our inventory before the next round of tariffs happens, for example?
Yeah, that's exactly right. And so imports were kind of elevated over the last 18 months since the campaign trail and folks talking about tariffs and trade policy. So right now our comps look a little bit low, but it's just because the volume was super high at this point last year. But imports definitely led the way. Those who could padded their stocks and advanced inventories to try to mitigate the price of the tariffs. But for the small to middle-sized company, they couldn't do that. And many are digging into savings just to pay for those elevated costs.
Interesting. Okay, so we are seeing those tariffs obviously get passed on in some cases to consumers. Where is the flow coming from? Are we seeing companies large and small try to make adjustments about where they're ordering from in order to try to mitigate the tariffs?
Most definitely. Go back to 2018. 60% of our business was with China. Today it's 40% and dropping. Seeing the migration of manufacturing to Southeast Asia, Vietnam, Indonesia, Malaysia, to name three. And that cargo continues to move. So even though we've lost share from China, the Port of Los Angeles is still growing because we've been super aggressive in the Southeast Asia market. But again, with prices rising, whether it's footwear, clothing, or even perishables, coffee, bananas, fruit and vegetables, we're seeing those price hikes across the board.
I'm curious, the administration has tried to crack down on Chinese goods flowing through those other countries in order as a way to circumvent the tariffs. Who is that up to try to discover where it's coming from? Are there folks who are regulators who are at the Port of Los Angeles who are checking this stuff and trying to figure that out? How does that all work?
It gets a little nuanced, and there may be some bad actors that are trying to circumvent tariffs. Right. But it's really an ecosystem, much like we have here in the United States for the automotive sector. Asia looks like this too. The shirt I'm wearing, the buttons and plackets are made in China. They're shipped down to Vietnam to make a shirt that's sold at Macy's, as an example. They're not circumventing the tariffs. It's piece goods that go into the final manufacturer. Just like brake pads and instrument panel seats go to Detroit for Ford to manufacture their cars, along with GM and Chrysler. So it's a little bit different. Now, who evaluates this? U.S. Customs and Border Protection. Right. They'll look at the 12-digit harmonized codes, the origin rules, origin destination pairs, and try to figure out exactly the content of a container and the shipments. That also gets very detailed. Los Angeles Customs District is the largest in the nation, and I can tell you firsthand, they're working day and night just to sort through all this information.
Well, since we're talking about regulation of that sort and enforcement of that sort, I have to ask you about immigrant labor as well at the ports. Obviously, there have been clashes in LA, there have been raids in LA on the part of ICE. Has that affected the labor force at the ports as well?
Well, what we've seen is rescinding 17,000 commercial driver's licenses, and that came from the U.S. Department of Transportation. Now, the state of California has 650,000 CDLs issued today. So while this impacts those people that were driving the trucks, we still have a very large base of truck drivers to do the business at the ports. About 20,000 are registered. Half of those call at least once a week, but very mindful of the work that's happening on the immigration side. And while it's been kind of narrow in Los Angeles, the port business continues on full throttle.
In terms of pricing, do you have any visibility into what happens now? In other words, do you expect continued increases in things like apparel and the other items that are coming into the U.S.?
Yeah, I think we're kind of at a unique point in time here. The small to middle-sized businesses, as I mentioned, are really grappling with how they handle these tariffs. If they try to pass them on, they still have to compete with the larger companies who have, at least to this point, tried to absorb some of the tariff increases while finding efficiencies and then passing on a little bit to the consumers. But if this continues down the same path, I see those pass-throughs happening in real time now.
Okay, gotcha. So that sounds like you do think prices are going to continue to go higher.
I do, and it's a conversation of national significance now. The inflation rates, interest rates, tomorrow's announcement from the Fed, and the ongoing affordability debate across a variety of areas, from medical care to how much it costs at the grocery store.
Right. All right, Gene, thanks so much for coming in. Appreciate it. Coming up, we're going to take a closer look at some of today's trending tickers. Stay tuned. You're watching Market Catalyst. We're getting a fresh look at how traders are positioning into year-end with the new Stacks report from Charles Schwab. The Stacks Index, which tracks the sentiment of retail investors, jumping to an 8-month high in November. Yahoo Finance's Josh Lipton spoke to Joe Mazzola, head of trading and derivatives strategist at Charles Schwab.
Joe, great to see you. So let's start right there, Joe. So the Stacks hitting an 8-month high here. What does that suggest to you, Joe, about risk appetite as we're heading into year end?
So let me put it in context, Josh, because at an eighth month high, it's still about the 65th, 66th percentile. So we're not in that nosebleed FOMO territory that you might have seen back in 2021. So it's bullish. But one thing interesting about this past month, Josh, is that only 2 of the 11 sectors actually had net buying, which is odd because you saw IT, you saw consumer discretionaries, and basically everything else saw net sells. So people were rotating out of some of the cyclical names into more of these the narrow leadership. It was the Mag 7, which like I said, I find interesting because it kind of flies in the face of what you saw with the overall market, where you had healthcare leadership, you had financials, you had utilities, materials that were kind of moving the market. But what we noticed is that the 5 main stocks, or even just the top 3, whether it was Nvidia, Palantir, Meta, they all shared something in common. They all had a 20% pullback during the month, and our clients jumped in and used it as an opportunity to buy.
In terms of what they were buying, Joe, you're kind of going leading me where I was going there, because I saw here, it did look, Joe, like a lot of sort of AI-heavy tech names. So I see Nvidia, Meta, I think Tesla, Amazon, Palantir. Yep. I mean, when you see that, Joe, is that just kind of tactical trading, or no, that's more firm sort of renewed belief in the AI theme and trend?
I'm going to lean towards tactical a little bit. I'm going to lean towards using opportunities, pullbacks to 50, 200-day moving averages, pullbacks, like I said, of 20% from all-time highs, as clients saying, look, we've been waiting for opportunities to get into these names. They're getting relatively cheaper. And remember, even with all of these names, they all had good earnings. It wasn't like they missed on certain targets. It was, for the most part, when you dug through the financial statements, or you had the post earnings call, it was hey, we're spending a little bit more than maybe we were expected on AI, and so some of the companies that had those type of announcements were punished. Meta being one, and so when clients got an opportunity to kind of scoop those up, they did. And the reason I say tactical as well too is because a perfect example would be Tesla. So Tesla, pulled back just shy of 20% on the month. Clients bought it, but then that was actually one of the top 2 stocks that they sold at the end of the month when they got that nice little rally back. So it was interesting there. And then the flip side is, if you look at the stocks that were sold, Apple, Broadcom, Eli Lilly, Rivian, Intel, these are all stocks that actually had really good months. Clients use those as opportunities to trim. I mean, perfect example would be something like Eli Lilly, rallied from 850 to 1110 or something like that. But if you're looking from a technical standpoint, Josh, it's like an 86 RSI. It's not something you see very often, and as opposed to kind of piling on and chasing the winners, they trimmed into strength. So I think that was pretty prudent.
What do you make, Joe, switching gears a bit here, of just the very high conviction that investors have the Fed is going to cut this week, Joe? I did have one strategist on recently. I know what you make of this. He kind of was making down, but he thinks that conviction is mispriced. He's not as certain of cuts coming, given where inflation is at. But what do you think?
I think when you head into a Fed meeting with conviction this strong, Fed Chair Powell in the past has not shown a willingness to go against that strength and conviction. Now, what he might do, and this is what I think a lot of us are predicting he will do, is he'll say, here's your cut. Don't expect any, in the near term while we wait for more data to come out. We do get some inflation data this week, but it's October data. So there's still stuff for us to kind of parse through as we're moving towards the next meeting in January. But I think the belief is there'll be a hawkish cut. And when I look at kind of what our traders and investors are telling us, the traders feel really strongly that there'll be a cut. The investors are a little bit less inclined to believe that. But when I just look at the history of Fed Chair Powell, and you see something as strong as, an 85, 90% likelihood of a cut based upon kind of what the markets are trading right now, he tends not to go against the grain. But who knows? Now they said it, watch, this will be the first time, right?
I'll get you out of here on this, Joe. I'm just curious, what do you make of those who argue the Fed is, in some sense, if they cut this week, they're risking their credibility, Joe, in that you're cutting even as inflation is above target, and 2%, they'll say, listen, that's a target, that's not a suggestion. So either decide, hey, it's not really 2%, and say it's 2 to 3, or don't cut. I'm just curious what you make of that argument.
I think that's a fair argument. I really do, and I think that they probably are thinking about that as well. I think maybe the difference would be this. It's not necessarily looking at the target in the near term. It's this belief that they can get there eventually. And I think that's probably what the markets are pricing. And Josh, I think what you're getting at is a debate that's been taking place, basically for the majority of the year is, can we get there towards those inflation targets while we're still cutting, or while we're having the end of quantitative tightening, or while we're having an accommodating Fed at this point? Because the belief is that, now that there's other undercurrents, whether it's tariffs or whether it's the change in employment, which is, kind of cut what we've seen in terms of labor supply. That has kept the unemployment number a little bit lower. But you have the Fed that's got these two competing priorities, and they're really supposed to be focusing on both. And it's a difficult position. And what I think investors are saying right now is, we think you'll figure it out, and we're willing to own equities while we're waiting for that. But yeah, I mean, I think if there's a shock in terms of maybe there's a little bit of over hawkishness, or however you want to state that, that could cause a little bit of volatility. I think this, given what we have, not only with the Fed meeting, but we think about this, Josh. We also have Oracle, we have Broadcom, we have those earnings that are coming up as well too. So there could be some volatility at the end of the week for sure.
You got some big names, Joe. As always, great to have you on the show. Thank you, sir.
Thank you, Josh.
Now time for some of today's trending tickers. We are watching Ares, 21, and Sallie Mae. First up, Ares, the stock jumping on inclusion in the S&P 500. The investment firm will replace Kellanova on the benchmark index. Kellanova, remember, it's the maker of Pringles, Cheez-Its, Pop-Tarts. It's being acquired by Mars. Ares is one of the largest companies by market value, not currently in the S&P 500. Wall Street fairly bullish on the stock, with 65% of analysts covering it, rating it a buy. Ares will join the S&P 500 ahead of the open on December 11th. Next, 21, ticker XXI, Roman numerals. The crypto firm falling in its first day of trading. Actually, now it's trading higher, up by about 5.5%. It had a SPAC merger with Cantor Equity Partners. 21 is the third largest Bitcoin treasury. It's led by Strike CEO Jack Mallers. Holds around $3.9 billion in Bitcoin, a sum higher than the company's current valuation. In addition to holding Bitcoin, 21 plans to work on financial infrastructure for the cryptocurrency and plans to create media and educational resources about Bitcoin. And finally, SLM, or Sallie Mae, those shares are sinking after the company held its investor day. The education lending firm forecast slower EPS growth and higher expenses. KBW analysts said the firm offered a, quote, sobering outlook relative to what investors wanted. Meanwhile, Morgan Stanley cut the stock to equal weight on near-term execution risk. Well, the Federal Reserve is expected to make one more interest rate cut before the end of the year. This could be good news for homebuyers looking for lower mortgage rates. Yahoo Finance's Josh Lipton spoke to Vishal Garg, CEO of Better.com, a digital home finance company, about the housing market in 2026.
Vishal, great to see you. So let's start there with the Fed. We do think, listen, a cut, investors are betting, is on deck by 25. If they do that, Vishal, I'm just curious, let's say they cut by 25. What's the effect on the 30-year fixed, which right now Mortgage News Daily says is about 6.36.
Yeah, so 6.36 probably goes down to 6.15, 6.1. Could go lower, depends on what happens, what the Fed says, are the reasons for why it cut, and if they kind of give a bearish outlook, you could see the rates go down to 6, 5.75. And that could unlock a lot of savings, because every quarter point rate cut is basically $1,000 a year in someone's pocket. In an average family's pocket. And so that's really meaningful in times like this when inflation is high. And, if you've got the ability to save, then you should rush in and look at it.
Can we already quantify, Vishal, how much the drop is already translated into savings for Americans?
Yeah, so, a quarter point rate cut on a $400,000 mortgage, right, is about $1,000 a year. And then as you keep going from there, the savings become bigger and bigger.
So let's we got to zoom out here. Let's say we're talking 12 months time, Vishal. Do you think 2026 for the U.S. housing market, would you expect, hey, it's going to be about the same as 2025, a bit worse, a bit better? I asked, I've had a range of housing economists on the show. You know, you throw two economists, you get three opinions. What do you think?
I think rates are going to be about a point lower. So I think the 6% rate goes down to about a 5% rate.
You do?
Yeah. I think the economy is not doing as well as people think it is. I think consumption is really in the top 10% of the country is holding it up, and that's because the stock market is high and people are sitting on massive gains in their stock portfolio, so they're spending those gains.
Yeah.
I think if the stocks stall, I think unemployment goes up. If the AI data center boom, it's like we have had no GDP growth if you take the AI data center stuff out.
The counter to that, Vishal, I hear that a lot, right? If we take out, but we do have the AI data center boom. I mean, it's...
And people are topping out.
Yeah.
People are topping out. It kind of feels like the AI story is like a little bit like 2000, 2001 in terms of
You hear echoes there.
Yeah, I see it. I was there.
Yeah,
like,
what are the echoes you hear, Vishal?
I think people are building AI data centers like people were building bandwidth and laying cables back in 99 or 2000. And I think that doesn't mean that the effects of AI throughout the economy, like e-commerce really took off 3-4 years after the AI, the e-commerce .com boom ended. So e-commerce took off in 2003, 4, 5, right? The savings from AI are going to be extraordinary. In our business, it takes us $3,000 to make a mortgage with AI that it takes a bank $15,000 to make. And that number, I tell people, is going from $3,000 to $1,000, and we're going to take all that savings and give it back to customers. And so that's going to be a lot of savings in people's pockets, but those savings are coming in the next couple of years ahead. And so I think you're going to see the housing sector really boom. I think you're going to see refinances become a real thing. I think people need the money. I think inflation remains stubbornly high. I think unemployment is creeping up. And I think financial security amongst American families is at near all-time lows. And so I think people are going to really need that rate cut for a typical homeowner to kind of either enter into the housing market or to refinance and take that savings and be able to spend on it elsewhere.
How many people, before you buy a home, obviously, you take into account all kinds of things, right? So it's a 30-year fix, but it's how you feel about the economy, the labor market, how secure your job is. So would that suggest, okay, in 2026, a lot more people are going to stay put?
Yeah, but 20 million people literally got pre-approved to go buy a house in the past 3 years, and they missed buying one in 2020, 2021, and household formation's been happening. They've been benefiting from what's happening in the economy, and those people, they need a place to live. And I think so. Basically, they're stalled right now. They're renters, and rents have been continuing to go up. So they need the security of a 30-year fixed rate mortgage where your housing payment stays the same for 30 years.
Let me ask you a bit more about your business. You run this AI-powered mortgage lender. Can you just explain to us, how is your business model, how is it different, Vishal, than what an average traditional mortgage company?
So we don't have all the offices around the country, we don't have branches, we don't have all of the fixed costs that are required there, we don't have the huge amounts of commission loan officers. So what we don't have is we don't have all that. We have AI taking care of a lot of that. We don't have the crazy back office, thousands and thousands of people doing processing and underwriting a mortgage. The AI handles all that. All that does is it makes our cost to make a mortgage about 80% lower than a big bank's and about 60% lower than your typical mortgage lender down the street. And now our business is thriving because what we're doing is not just on better.com, letting customers get a cheaper rate and a faster mortgage, save time and money by coming to better.com, but we're not taking that technology and rolling it out to other fintechs, to other banks, to other mortgage companies so they can make their businesses better. And that has led to a boom in our business. Our business is double what it was last year. We're expecting it to double again next year. And so we're pretty pumped for what AI can do for us.
Can I ask you, who's your average customer, Vishal? Who's the demo? Is it different than a traditional mortgage company?
No, I mean, the average consumer is actually someone who's not well serviced by like a private wealth management group at Citibank or Chase or Wells Fargo. The average customer of ours is someone who is comfortable with technology, is buying a $400,000 house, putting down about 12% down, has a decent credit score, not amazing, like 720 credit score, and has a debt to income ratio in the sort of 35 to 40% range, and they're just a good average American family trying to buy a house and get into a home, and savings matters to them. So like a Costco shopper.
I have seen you, Vishal. I've seen and heard your company compared to Figure. How do you compare and contrast there?
I think what Figure does, and they're great, they've been doing it for 7 years. They're a leading home equity finance company. They let people take equity out of their homes and get a second lien mortgage on it. And they use it to pay back their debts or to make a home renovation. We have come out in the past 18 months. We are the fastest growing home equity finance company. And again, what we're doing is Figure is basically making the loan and securitizing it. They hold on to it. We have built an AI-powered marketplace of a whole range of investors. And by doing that, we're able to give customers a lower rate than Figure and a higher approval rate than Figure, because we go out to the entire investor market and we find an investor that matches your criteria. And so our approval rates are 2, 3, 4 times that of Figure's. And that's why we're winning. That's why we're growing 6x faster than they are now.
Let me ask you, if I'll get you out in this, because we're going into year end. I have to ask you. Last I checked, your stock was up like more than 400% this year. How much time as a CEO do you spend thinking about that, looking at that stock chart?
I don't think about it at all.
You don't?
I want to help more customers.
Yeah.
I want to push the AI to do more. I want to save more money for our customers. I want to lower our interest rates. I want to get more investors on the platform. All I care about is lowering rates and giving back our customers time that they can spend with their families. That's what I spend my time thinking about.
Vishal, great to have you on the show today, especially on set. Thank you, sir.
Thank you so much.
Coming up, we're talking to one of crypto's earliest pioneers about the latest price action and strategies doubling down on Bitcoin. Bitcoin is back above the $90,000 level, recovering somewhat from a steep sell-off in November. The cryptocurrency roughly flat for the year despite hitting record highs in the fall. My next guest is one of the earliest crypto pioneers. In 1997, he invented a system called Hashcash, an algorithm that helps prevent DDoS attacks. His work was cited by Satoshi Nakamoto in the Bitcoin white paper, and he even exchanged emails with the mysterious Bitcoin founder. He's even been floated by online theorists as a potential candidate for Satoshi's identity, though he's always denied those rumors. Adam Back is with us now, Blockstream co-founder and CEO. Adam, thanks so much for being here. Appreciate it.
Thanks for having me on.
So this year has been an interesting one, to be sure, for Bitcoin and for cryptocurrency more broadly. But perhaps it's a bit surprising that we close out the year not with big gains, considering we hit new milestones of institutional adoption and new sort of regulatory and legislative support also. So how are you thinking about it as we close out the year, given that kind of support?
Yeah, I mean, I think Bitcoin is typically short-term volatile, and no difference here. I think the market is a little different now. There are more institutional buyers who are slow and steady buyers. So there is this cycle where Bitcoin, goes through bull market and bear market phases. So I think there's a bit of speculation that could be the case, but there were some structural issues that caused the sell-off. Some exchange issues and macro news and high leverage, basically. So we're already about 15% off the lowest it got to a few weeks back. And, JP Morgan, for example, is calling for $170,000 in the next 6 to 12 months. Tom Lee from Stratfor is calling for $200,000, similar time frame. And there's a lot of institutional buying, which I think is it's very early stages so far.
I mean, some of those folks were calling for those kinds of price targets for the end of this year, and we haven't quite gotten there. But, I mean, broadly, would you agree with those kinds of numbers that you see in here?
Well, I think it's very difficult to, predict timing, but I think people have short memories too, right? Recall the last cycle, we had a 69,000 top around this time, about 40% through the cycle. And people thought that was the top, but it put in a higher top much later in the cycle, right? So I think the timing within the cycle is getting over focus. So if people zoom out and consider that the timing is less accurate, and there are different buyers now. The ETF buyers are quite sticky. They're sort of long-term investors. The Swiss National Bank buy MicroStrategy. Some of the Abu Dhabi sovereign wealth funds buying Bitcoin, some of the pension funds buying Bitcoin, and a number of banks, and investment companies like Fidelity calling a 1 to 5% allocation, Bank of America 2 to 4, and BlackRock 1 to 3. Were the first ones putting out a model price target, as a model portfolio allocation. So I think those are they're very interesting. They build comfort and support within the investor community. But those things take time to take effect, right? Because the banks have to go through trainings programs, get their salespeople the information. So I think that continues to come through in the next few years.
Adam, as somebody who was around, at the inception of Bitcoin, is this how you thought it would play out? I mean, I know that earlier in its sort of development, there was more talk about it being used for transactions, and it sort of evolved to be more of a store of value. Did you think it would play out that way?
Well, it's pretty interesting to see it develop over the years, and I guess a broad analogy would be the internet. So the internet originally was kind of counterculture. There were very, very small percentage of the population on the internet. Then it became mass market. Then all major companies had internet, their web pages, internet services, smartphone apps. It just continues, right? And so I think ultimately the investors are going to want to invest in the adoption of Bitcoin by users. So it's a kind of secondary effect. And I think the other thing to bear in mind is that while there are large amounts of retail payments in Bitcoin, primarily in the emerging markets, where there's more underbank situation, that it delivers a lot more to price formation if 1,000 users invest $10,000 to $100,000, then if 1 million users flow rapid transactions through, there's much higher velocity, and the merchants tend to convert to dollars or euros on the way out. So I think for the time being, the investment case is driving, the digital gold and unseizable global money is driving the price formation.
And when we look at the different ways that people have cooked up to invest in Bitcoin, I mean, I know that you're involved with the Bitcoin treasury company, but I think of Strategist sort of most notably in terms of the amount that it holds. Is that really the most effective way for people to get access? Or, for most people, if they're going to invest in crypto, does it make more sense for them to invest directly?
Definitely nothing wrong with investing directly. And you think about the Bitcoin treasury companies as a kind of Bitcoin derivative. So there are sort of 1.5 and 2 times long Bitcoin ETFs. It has a different risk profile to that. And I think, the answer for the treasury companies, some people say, oh, they're accumulating a lot of Bitcoin. I think the answer there is buy more yourself. Effectively, it's taken a while for other companies, other public market companies to follow Michael Saylor in the treasury play, but there's been a lot of activity this year, and some big established companies, like Tesla and so on, also have sizable Bitcoin positions. So I think ultimately all companies become Bitcoin treasury companies to some degree because it's an inflation hedge in a sort of longer time frame.
Well, that partially answers my next question, Adam, which is how do you see the evolution of the cryptocurrency ecosystem if you look 5 years from now, 10 years from now?
Yeah, I mean, I think, having experienced the previous 5 and 10 years, things have moved much, in the short term, people don't see the speed of development. But if you go back 5 years, it's pretty surprising where we are. If you go back 10 years, you wouldn't have expected at that time all of the major banks to be vying to provide Bitcoin-related products and services, making model portfolio recommendations, sovereign wealth funds, buying Bitcoin, pension funds, all of these things. And there's been a lot of regulatory improvement over this past year as well in terms of the types of banks that are now able to be custodians. So I think that opens the gate for people. Mm-hmm. And coming back to the MicroStrategy question, I think there are sort of mandate questions where some types of managed funds can only invest in shares, so they can't invest in Bitcoin the asset or Bitcoin ETFs just because of their mandate, right? So, and there are also tax arbitrage advantages for treasury companies. So, in Japan, that's particularly the case for Metaplanet. Some countries were buying MicroStrategy shares because they weren't able to hold Bitcoin ETFs in a tax advantage retirement account, for example, so they buy
Right.
more energy. I think things to bear in mind with treasury companies got more volatility, but they are working for you. They're increasing the Bitcoin per share over time. So if you can establish a good entry point, you can hold that for long term, and it can
Right.
obviously, the hope there is it outperforms an ETF.
Adam, we have to leave it there. Thank you so much. Appreciate it. That's it for Market Catalysts.